Most people throw away $2,000 every year by not using their credit cards to buy dividend stocks. And I'm about to show you exactly how to capture that money while building wealth. Seriously, this is the intersection of credit optimization and investing that literally nobody is talking about. Hey, welcome back to Credit Mastery. If you're new here, we break down credit card strategies, 0% APR hacks, and cashback maximization that banks don't advertise. Hit subscribe if wealth building through strategic credit is your thing. Here's what we're covering today. How to use premium cashback credit cards to buy dividend-paying stocks under $20, earn rewards on the purchase, collect quarterly dividends, and essentially build passive income on free money. Let's do this. First, the foundation. High-yield dividend stocks under $20 exist in specific sectors: telecom, energy, REITs, and select utilities. Companies like Altria, AT&T, Verizon, and Energy Transfer pay yields between 4 to 9%, meaning if you own $5,000 worth, you're getting $200 to $450 in dividends every single year, just sitting there, passively. But here's where it gets interesting. Most people buy these stocks with cash or debit from their investment account. They get the dividend. That's it. What if I told you there's a legal way to earn an extra 2 to 5% on top of that dividend just by changing how you buy them? Enter premium business credit cards with 2 to 5% cash back on purchases. Let's do the math everyone needs to see. Say you have $10,000 to invest in dividend stocks. You're looking at AT&T stock at $19 per share, yielding around 5.5% annually. Scenario A, buy with cash or debit. Stock purchase, $10,000 annual dividend, $550. Cashback earned, total first-year return 5.5%. Scenario B, buy with a 2% cashback business credit card. Stock purchase, $10,000 with card, instant cashback, $250 annual dividend, $550. Total first-year return 8% immediately. That's not a gimmick. That's $250 in instant free money, and then you get dividends on top of it forever. Now, the credit cards that make this work. We're not talking about basic cards. You need cards specifically designed for business purchases with high cashback percentages and critically 0% APR introductory periods. The Chase Inc. Business Preferred gives you 3x points on the first $25,000 in combined purchases, which translates to roughly 3% cash back when redeemed for statement credits. The 0% APR period, 12 months on purchases and balance transfers. The American Express Business Gold hits 4x points on up to $5,000 in combined purchases per quarter. That's essentially 4% cashback, capped smartly so you're not overspending. The Capital One Spark Business Card gives flat 2% unlimited on all purchases. No caps, no rotating categories. Simple, effective. Here's the critical part. If you're carrying a balance, you need that 0% APR period. Buy the stocks in month 1, use the 0% window strategically. If you pay off the entire balance before the promotional period ends, you've paid 0 interest and captured 100% of the cash back. That's the optimization. But wait, there's a mistake everyone makes here. Tax implications. When you buy a stock on credit and take a cashback reward, that reward is considered taxable income by the IRS. It's not a return on investment, it's a rebate. You report it as miscellaneous income. On a $10,000 purchase earning 2.5% cashback, that's $250 in taxable income. If you're in a 24% tax bracket, you're paying about $60 in taxes on that $250 reward. Does that kill the strategy? No, you're still ahead. But you need to know this going in. Dividends, on the other hand, are taxed at capital gains rates if they're qualified dividends, which most stock dividends are. That's typically 15% for middle-income earners. The dividend is taxed on the stock, not on the credit card purchase. 2 separate tax events. Let me give you a real example that shows the power of this compounded over time. You have $50,000 to invest. You decide to build a dividend portfolio under $20 using a 2.5% cashback business card. Here's what happens. Month 1, buy $50,000 in mixed high-yield dividend stocks, AT&T, Altria, Energy Transfer, etc. Cashback earned, $1,250 instantly. Annual dividend yield, 5.5% average, $750 per year. You take that $1,250 cashback and buy more stock with the same card. Additional cashback, $31.25, Additional annual dividends, $68.75. Year one total passive income, $2,890 from a credit card hack. But here's where it accelerates. In year two, your dividend payments are larger because you have more shares. In year three, even larger. And every quarter, you're getting dividend payouts that can be immediately reinvested on the same cashback card. 5 years in, you've built a $60,000 plus dividend portfolio while earning $3,500 per year in passive dividends, all accelerated by the initial and ongoing cashback rewards. That's not hypothetical. That's how wealth compounds. Now, the critical warnings. Do not max out your credit utilization trying this. High utilization tanks your credit score, and a damaged credit profile costs way more than you'll make in cashback. Never spend more than 10 to 20% of your total available credit on this strategy. Second, only do this if you can pay the balance in full before any APR kicks in. If you're carrying a balance, you're eating interest, and the entire strategy inverts into a loss. Third, dividend stocks under $20 often have higher volatility. AT&T isn't going bankrupt, but Energy Transfer can have price fluctuations. You're not speculating on gains here. You're collecting income. Know the difference. Here's the one thing 99% of people miss: reinvestment automation. Once you execute this strategy, set up automatic dividend reinvestment, DRIP, through your brokerage. Every quarter, those dividends automatically buy more shares without you touching anything. Then quarterly, use your cashback rewards to buy more shares. You're literally stacking passive income on passive income. 6 months into this, you're not thinking about it anymore. You're just watching the compounding happen. The people who get wealthy through dividend investing aren't necessarily the ones picking better stocks. They're the ones who automate the boring stuff and let time do the heavy lifting. So here's what you do next. Step 1. Open a premium business credit card with at least 2% unlimited cashback or 3 cents plus on purchases. Step 2. Research dividend stocks under $20. Your broker has screening tools. Look for yield above 4%. Step 3. Invest $5,000 to $15,000 initially, not your entire net worth. Step 4. Set up DRIP and automate dividend reinvestment. Step 5. Make a calendar reminder every quarter to check in. That's it. Step 6. Reinvest your cashback rewards by buying more shares. The math compounds. The passive income builds. The credit score stays strong because you're responsible. And in 5 years, you've built a real, dividend-paying asset while optimizing credit in a way 99% of people never even consider. This is